All right. Hello, everyone, and welcome to our Solo 4K and Self-Directed IRA live Q&A. We're excited to have you all with here to us today. My name is Aurelia with Sense Financial. We are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. We have some pre-submitted questions from you all today, and as always, if you have any questions that you'd like to ask, please feel free to use the chat button at the bottom side of your screen to send us your question. We'll answer them chronologically after we answered your pre-submitted questions. Before we begin, allow me to introduce our speaker and expert who will be answering your questions. I'm here today with Dimitri, our president and founder of Sense Financial. Dimitri began his career in financial planning and real estate investing in 2000 and is a California real estate broker. He holds a designation of Certified IRA Services Professional from the American Bankers Association. Over the years, he has taught hundreds of investment and financial planning seminars and mentored thousands of investors. So, welcome, Dimitri, and thank you so much for joining us today.
Really, it's great to be here with you. Welcome, everybody, and looking forward to jumping in.
All right, we'll go ahead and start with our first question for today. The first question is from Daniel. What are some creative ways to turn locked up equity in existing properties with or without an existing mortgage into usable cash or cash flow? I have properties in both traditional and Roth accounts.
Well, Daniel, this is a investment question, and so there is a limited help we can provide you here. I can probably give you some ideas, but as far as unlocking the equity, if you own a property inside of your self-directed IRA or 401k, you can potentially do a cash out refinance. Remember, you must use non-recourse financing. The loan must be non-recourse. You're, as a plan participant or account owner, you're not allowed to provide a personal guarantee, so you have to get a non-recourse loan, which means the property is the only security for the loan. We have several lenders that specialize in this. You can get a list of those lenders on our website, and you can arrange financing with them. Those lenders will finance purchase of the property, but you can also refinance existing property, again, assuming that you meet the criteria of the lender. And different lenders have different criteria, but you can potentially do a cash out refinance. You can pull that cash out. It belongs to the 401k or an IRA, and then you can use those funds to reinvest. How to reinvest? That's the freedom of the self-directed solo 401k or checkbook IRA. You got the freedom to invest however you wish. Our clients invest in things that they do know and understand. Obviously, you have much greater control compared to the stock market, but we're not going to be able to give you investment advice and guide you how to invest those funds. That's something that you're going to have to make your own decisions, but the concept was explained to you. You certainly can pull the equity and reinvest.
Our next question is from Elkie. Elkie is asking if I want to change the name of my self-directed 401k, how is that done?
Well, it might be possible, but it's not something that I will recommend because it's going to be quite a process, and it's going to involve everything, all of your assets, all of your accounts, involve the IRS. So it's quite challenging process, actually. So that's not something that I will recommend. I want to understand. Perhaps you can email me directly the reason why you want to change. There might be some alternative ways, but it's not something that we typically recommend doing.
All right. Elkie is also asking, how do I borrow against or from my account? Does it trigger any taxes? And can I roll over a pension? If so, how?
Well, if you would like to, you can borrow against your account. So that's not possible. What you can do is you can take a participant loan from your solo 401k account. So if you have a self-directed solo 401k plan, the plan allows you to take a participant loan, which you can borrow from the 401k, not against it, but from. The loan is limited to $50,000 or 50% of the balance, whichever is less. And the process is pretty straightforward. You complete loan application. You have to do the loan calculation to calculate how much you can actually borrow. We provide you with the loan calculator so that you can set up your amortized payments. Again, the loan is a 5-year, must be amortized over a period of 5 years using principal and interest, and the interest rate is set as prime plus 1%. As a client, you have access to that. You can log into the client portal, go to the maintenance section, and then click on the participant loan, and detailed guidance will be available for you there. So the follow-up was, does it trigger any taxes? No. You're not taking a distribution. You are taken a loan from the 401k, so it's not a taxable event. And I believe there was a follow-up question about the pension, right?
Yes. Elke asks also, can I roll over a pension? And if so, how?
The self-directed solo 401k plan will accept rollover from any other qualified retirement plan with the exception of Roth IRA. So if you have a Roth IRA, existing Roth IRA cannot move that into solo 401k. IRS doesn't allow that. But if you have any other qualified retirement plan, you can, including pension. So the question will be to the pension. So you have to contact your pension administrator and inquire with them on to as far as the rollover process. So 401k will accept that. The funds or the check needs to be made payable to the 401k FBO, your name, and but the initiate the process, you have to contact your pension company.
Thank you, Dimitri. Our next question is from Selena. Selena is asking, can I convert my solo 401k to a Roth solo 401k? And I believe you had answered that question previously.
Well, yes. The question is, can the Roth conversion be done inside of a solo 401k? And the answer is yes. You can do the Roth conversion inside of your solo 401k. Solo 401k plan, each plan that we create comes with the Roth subaccount or the ability to make Roth contributions. So you can contribute as a Roth, you can roll over existing Roth funds, again, except Roth IRA. So Roth IRA cannot be rolled over into solo 401k, but if you have another Roth fund, such as you have an old 401k that is Roth, or perhaps 403b or 457, then those funds can be rolled over. And you can also take existing funds that are pre-tax and you can convert them to a Roth. That will be a taxable event. It has to be reported to the IRS and you'll have to pay taxes on the amount of the conversion. Again, we do provide guidance on that. You can head over to the client portal, to the knowledge base, and just search for the article named Roth conversion. And we provide detailed guidance there. So it's possible. The benefit is that you're paying taxes now once, and then your investment can grow forever tax-free because investment income and return and all the growth inside the Roth will not be subject to taxation, unlike pre-tax. So it does make sense. In some cases, you have to evaluate this with your CPA because there's a number of factors that you need to consider, but yes, it is possible. And before we move on to the next question, I just want to encourage you who are joining us. If you have a question, you can just type it there in the chat section. We'll answer that. And remember that it's not only you who benefiting from the answer, but everybody who's on the call and who's going to be watching the recording. So go ahead and submit your questions.
All right. For our next question is from Corolla. Corolla is asking, what is the process to start using funds to buy real estate with available funds?
Well, if you have a self-directed solo 401k or checkbook IRA for that matter, the process is pretty much the same. You have to identify the investment and then do your own due diligence. If you're financing the property, you have to arrange the financing with one of the non-recourse lenders. And then you're going to make an offer. You're going to go into a contract. If you're doing that using a solo 401k, then you're going to use your solo 401k trust as the buyer. As a trustee of the solo 401k trust, you'll be signing everything. So you can in control, you'll be making an offer, you'll be signing the documents. If you're using a checkbook IRA, whether it's an LLC or a trust, the same concept. LLC or a trust will be the buyer. And as a manager or trustee of the trust, you'll be signing the documents. And then once you're ready to close on the property, you will wire the funds from the bank account for your checkbook IRA or 401k into escrow. and the title will be taken in the name of the entity that is making an offer. So it's pretty straightforward. And then all the income from the investment must be flowing back to the retirement account, and all of the expenses related to the investment must be paid from the account.
All right. We do have some questions coming here in the live chat. Fred is asking, I will be receiving income from an investment that is within my self-directed checkbook controlled Roth IRA. Does it matter if these funds are wired directly into my self-directed checkbook controlled Roth IRA, or must they be wired directly into my account held by my custodian? He also noted, I'd prefer the funds to be wired directly into my checkbook.
Well, if you have a checkbook IRA, meaning you have probably an LLC that your IRA owns, the investment is made or owned by the LLC. So the return on that investment, or when investment is liquidated, must go back to the investor, which is again the LLC that your IRA owns. So it's not going back to the custodian, it's going back to the entity that owns the investment. The custodian is not involved in this case. That's why you have the checkbook control and you're able to bypass the custodian.
And our next question is from Esdraji. Do you provide services to complete the 5500 Easy, and what are the potential pitfalls that can occur with this form?
The Form 5500 EZ is an annual return that is required for our clients who have a self-directed solo 401k plan. And this form is required to be submitted to the IRS if your total plan assets, it's not just the cash in the bank account, but it's total plan assets. So whatever your 401k owns, you have to sum it all up, add up all of the assets, including all the cash. And if the total is over 250, then you have to submit this form. It's the due date on that form is end of the 7th month following the end of the plan year. So assuming that your plan year end is in December, then you will have to file this form by July. It's pretty simple form, only 2 pages, pretty straightforward. You can either do it yourself, we provide guidance on how you can complete that form, or if you would like our team to file it for you, we can do that as well. We do offer this service. There's really no pitfalls completing this form. In fact, we do recommend you start filing this form even if you're not required. If your total plan assets below $250,000, we do recommend that because you get the clock start ticking and you get the statute of limitation going, so you'll benefit from that. And you also establish the record with IRS. And you also get into a habit of filing this form. It might be more difficult for you to file first year because you never done it, but once you file it once, it's going to be easier and you'll get into a habit of doing that and you won't miss. The penalties are really severe for failing to file, really severe. It total to about, I think, $150,000 per year. So as you can see, it's pretty steep. Make sure that you're taking care of that and not miss it.
All right. Those are currently the questions that we have for now, but we'll allow a couple more minutes for everyone to pitch in any questions that they may have, and we'll be able to answer them live.
Yeah, as we're waiting for more questions, just to expand a little bit on the Form 5500 EZ, what you need to watch out for is if your plan year end is different than a calendar year. Sometimes we have clients who their corporate fiscal year end perhaps can be in September. All right. So, and then they set up a plan year to be in line with that to also end in September. Well, then your deadline for filing Form 5500 EZ will shift, and it's going to be end of the 7th month following end of the plan year, which is going to be in September. So be mindful of that. We always recommend filing as soon as the Form 5500 for the current year becomes available, typically in February or so. But again, the deadline is coming up here. For most people, it's going to be in July.
Thank you so much, Dmitry. Okay, it looks like we don't have any additional questions at this moment. So I'll just thank everyone for joining us today. If you have any questions at all, you can always reach out to us via email or contact us at our website, SenseFinancial.com. For email, you can reach out to us at contact@SenseFinancial.com, and one of our admins will reach out to you and assist you with any questions that you may have.
Thanks so much for joining, and we'll see you next time.